Hello everyone, Brad Tenen here from Best Wealth Management. Thank you for tuning in over the past 4 videos. Today is the final video in the Market Volatility series, and so I hope that you've really enjoyed the content that I've presented so far. And today we're going to wrap up with the final topic, which is focus on what you can control. So with that said, let's jump right in. The very first thing that I would encourage you to do is to engage in financial planning. A lot of times what you will discover is that if a person has a particular goal that they're trying to reach, they may be able to achieve that goal without taking on very much risk. In fact, they may not even need to be that much invested in the stock market to begin with. But you would ultimately never know that unless you actually engaged in financial planning to find out what your degree of success would be with that particular goal. So I have a point to actually illustrate this. One of our clients had emailed me and said that they were thinking of contacting us to shuffle their investment mix around. And ultimately, that's the wrong approach. You don't want to adjust your investment mix between stocks, bonds, and cash just because of the market volatility. But when you do want to do that is in response to your goal. So after engaging in financial planning, you may find that you don't need to take on as much risk, and that would be actually an ideal time to change the mix of the portfolio. So always let the goal dictate the mix, not the volatility or the noise in the market. Secondly, invest. This is an ideal time to invest. The markets have declined. It might even be a way to help you to play catch up because you're able to invest off of the market highs, since this had declined at one point by around 20%. So now you're able to buy into the market at a lower price. And I never have really understood why people don't do this, because they become so fearful with their money when the markets decline that they're hesitant to put more money into it. But everything else in life, we enjoy it when it goes on sale, but for some reason the stock market is treated differently. So I would encourage you to fight that feeling that you have and use this as an opportunity to actually invest your money. Number 3 is create an investment plan and stick to it. And I would say that you need to have a solid, reliable investment plan, not just one that you get a little bit of information over here from the media. You get some information from your coworkers, perhaps you get some information from your family during the holidays, and you're constantly changing your investment portfolio based on what other people say or what sounds good at the time, and you're essentially moving as the wind blows. That's not really an investment strategy. So identify what would be a solid, reliable investment strategy and actually stick to it. And we actually here at Best Wealth Management, we structure our clients' portfolios around what we call dimensions of expected returns. And said a different way is when you're invested in the stock market, there's many different types of sectors and sizes and so forth of stocks in the stock market as a whole. And so some of those areas actually outperform others. So based on the research that's been done, we've identified what those sectors are, and we actually tilt our clients' portfolios and invest a little bit more in those areas to capture those higher expected returns when they show up. Number 4 is to diversify globally. And I want to pull up a series of slides here that help to illustrate this point. If you follow the stock market at all, you know that the S&P 500, which is the 500 largest U.S. stocks, or stocks in the U.S., it's been outperforming pretty much everything over the past decade. But what I want to do is go back to the 1970s and pull us all the way through to the present time. If you look at the 1970s, a globally diversified portfolio significantly outperformed the S&P 500. Then if you fast forward to the 80s, the same trend happened there. And then we get to the 90s, and that was the big tech boom during that time. and the S&P 500 took off, and it was a very good performing sector of the market. And then we get to the 2000s. The 2000s saw the tech bubble burst, and in actuality, that entire 10-year period from 2000 to 2009, the U.S. stock market actually lost 1% per year. And this is what you're trying to protect yourself from. So even though the S&P 500 has been the best performing asset class for the past 10 years or so, you can end up in situations like this slide shows, where a 10-year period invested in the S&P 500 would have lost somebody about 1% per year. That would not be a very comforting thing to have lost that much money over that period of time. However, a globally diversified portfolio, although it doesn't say it on the screen, when you run the numbers, it actually had returned around 7.5% per year. So yes, there may be some periods where you sacrifice some upside when the S&P 500 does better, but being invested in a globally diversified portfolio helps to protect you from this 2000 to 2009 type period. And by the way, this is known as the lost decade for the S&P 500. Then we go from 2010 through 2017. And again, here's what I was saying is the S&P 500 is actually outperformed a globally diversified portfolio. And you're going to have periods in time where this exists. And so your goal is not to chase assets or chase categories. Your goal is to protect your asset and generate a decent return. And so even though the S&P 500 has done better over these last 10 years or so, it's still not reason to invest solely in that over a global diversified portfolio. And then lastly, if we look at the entire period from 1970 through 2017, we see that the global diversified portfolio actually outpaced the S&P 500 significantly. So your goal is to invest in a way that is meant to not take great risk in any one area, like the S&P 500 does. So diversify globally. Number 5 is to manage expenses, turnover, and taxes. There's no need to have investments that carry these tremendously high price tags on them. Additionally, those investments that do oftentimes have a very high turnover, which means that they're constantly buying and selling stock within that particular investment. And when you have that high turnover, you ultimately end up having higher expenses and higher taxes. So I would encourage you to avoid investments like that. And lastly, stay disciplined through the ups and downs of the market, and at all costs, do not follow your emotions. Emotional decisions in life are oftentimes not good, and the same holds true with investing. And what normally happens when people invest with their emotions is they have some level of optimism. The market and the economy is doing well. Stock market starts to do well or is doing well. And then people want to get on that bandwagon and they want to buy in at that point. And when they do so, they're technically buying in at a higher point. And then as the economy starts to go south and things aren't going as well, people get nervous and even fearful, similar to what's been happening with the recent October and December declines, significant declines that we've seen over those 2 months. And then people start to panic and wonder, should they change their allocation mix and so forth. And they oftentimes will make a decision to do that, and they end up selling as the market has declined in value. And so that's a buy high and sell low strategy, which is the opposite of what somebody should be doing. And I want to pose this question to you. What's the alternative? If you don't buy into what we've been saying over the past 5 videos, then what is the alternative? Do you get out? Do you identify some sort of technical indicator or trend or ratio and invest based on that? Do you look at it and say, oh, I'll learn from this time and I'll get out next time to avoid the declines? Hopefully the information that I've presented to you over these past 5 videos shows you that the evidence is solidly against you if you try to pursue those strategies. So in summary, I wanted to wrap up and again just thank you for tuning in over these past 5 videos. But in summary, I encourage you to tune out the noise. Don't listen to the media. Don't listen to the naysayers and the headlines. They're in the business of selling entertainment, not financial advice. Secondly, the when the markets decline, not only is it normal, it's also expected and healthy for that to happen. Because remember, without risk, you can't have the potential to earn the historical 10% return of the stock market. And then no one knows ultimately when the market declines are going to come. So I would encourage you to not listen to that noise. There's no reliable evidence that shows that you can actually pinpoint various metrics that show you when you can get out of the market. And then in the 4th video, we talked about you must be present to win. And I showed you my favorite chart where if you had missed the 25 best trading days out of a 7,000 day period, your return declines more than half. And those are odds against you. There's no way you're going to be able to identify those 25 days out of 7,000. So stick with the boring investment strategy, stay the course, which, as I said before, is oftentimes the most difficult thing to do. And then lastly, as I mentioned today in this video, focus on what you can control. Focus on the financial planning that helps you to tie a goal to your investment. Consider investing during this down period. Create an investment plan and stick to it. Diversify globally, not in just one sector like the S&P 500. Make sure that you're managing the expenses, turnover, and taxes on your investment, and stay disciplined and don't make emotional decisions when it comes to your investments. So I hope that throughout this entire series you've been able to be put at ease. You're a little bit more comfortable now. You have some data, hopefully, that I presented that helps to ease some of the concerns that you have. And if I would encourage you, if you have any further questions beyond today, then by all means reach out to me. Send a comment directly below the video or shoot me an email, whatever the case. So, but in any case, I really appreciate you tuning in. I hope that you've learned something here over these past few videos, and look forward to connecting with you. If you're not connected to us through our to receive our content, please sign up directly below this video. Thanks for tuning in. Take care.